is now being recorded.
Welcome. Thanks everyone for joining us today. I'm Katherine Groves, the Senior Loan Officer with Capital Impact Partners. So, you're excited about the greenhouse concept and now you're looking to build a greenhouse home. How do you go about financing it? Today's presentation will help you develop a framework for financing your greenhouse project. I will explain how to develop a capital strategy, explore financing options, and apply for financing. I will also highlight loan opportunities that are available to bring projects, especially those serving low-income elders, to fruition. I'd like to walk you through the agenda today. First, I'll give an introduction of capital impact and explain what our role is in the Greenhouse Replication Initiative. Then we'll discuss 3 steps to consider when exploring financing options: developing a capital strategy, exploring financing options, and applying for financing. As we are recording this session today for future use, questions will be held until the end of the presentation. About us. Capital Impact Partners is a leader in financial and social innovation for communities. A nonprofit organization and certified community development financial institution, we bring our roots in cooperative development, diverse network of partners and problem-solving know-how to connect communities to the capital and capabilities that create social change. We bring high-quality healthcare, healthy foods, housing, education, and aging support to facilitate change within a community on a national scale. We accomplish this in 2 primary ways: by providing technical assistance programs, like the Greenhouse Project, and by providing financing opportunities in these sectors. As a senior loan officer, I work with organizations to understand their financing need and to structure financing terms to meet that need. The Greenhouse Replication Initiative is a joint initiative between Capital Impact, the Robert Wood Johnson Foundation, and Dr. William Thomas. The Greenhouse Replication Initiative provides technical consulting services to organizations interested in implementing greenhouse homes, and Capital Impact provides financing opportunities for greenhouse homes serving low-income elders. To date, we have assisted in the development of over 153 greenhouse homes and have provided over $33 million in financing to greenhouse homes across the country. We'll begin with step 1, developing a capital strategy. Before exploring your financing options, it's helpful to understand the facility development process. Mapping out this process will help you plan, develop, and finance your greenhouse home. The facility development process consists of 4 phases. The financing process occurs in parallel with the facility development process. The first phase is the concept phase. During the concept phase, your organization is exploring its options, assessing its needs, and formulating a plan for moving forward with the facility project. By the end of this phase, you should have the appropriate resources in hand to allow your team to define and implement a project concept. Some of the key elements of this phase are writing a business plan, a feasibility study, a needs assessment, and a preliminary capital budget. The second phase is the pre-development phase. This phase involves assembling the development team, site selection and preliminary site control, developing a preliminary project budget. During this phase, you might consider seeking pre-development financing. You can secure pre-development financing if it is necessary for your project and if it is available to you. This financing is designed to help you cover some of the costs associated with pre-development activities. It is intended to be taken out by construction or permanent financing associated with your project. So once you've got a good handle on the elements of the pre-development phase, you will want to secure informal financing for your project, such as a letter of interest or a term sheet from a lending institution. The third phase is the development phase. This is when your project really starts coming together. It is during this stage that the development team pulls together the ideas, desires, and constraints to shape them into a viable plan and ultimately into a tangible project. The stage involves facility design, pre-construction activities, developing a complete project budget, obtaining site control, obtaining third-party approval such as planning and zoning. As this stage comes together, you'll want to secure a firm commitment for financing, such as a commitment letter. The final phase of the facility development process is the construction phase. This is where your project becomes a reality. In this phase, you will finalize your agreement with the general contractor and finalize the construction contract. You'll close on financing, initiate construction, manage construction, and eventually leading to the project closeout and final occupancy of your facility. So when you think about the facility development process, financing is really a parallel process that starts after the concept phase and goes through the construction phase. Developing your capital strategy starts in the concept phase. In the concept phase, you will have developed a preliminary capital budget or a project budget that estimates the sources of capital needed and the anticipated expenditures of your facility project. Using the project budget as a baseline, consider your debt and equity requirements. Equity would be money that does not need to be repaid or an asset. You'll typically need 10 to 20% equity for a capital project. For example, when you buy a house, you're required to put down a down payment of 10 to 20%. Debt is money that needs to be repaid or a liability. So this is when you're buying a house, this would be the mortgage loan that you would take out from the bank. When you think of equity, you can consider many different types of equity. So cash is a traditional form of equity, but your organization maybe doesn't have a large cash reserve. You can also think about grants, donated land value, forgivable or friendly loan from a public entity, for example. If fundraising is a big part of your capital strategy, you will need to develop and launch a capital campaign. A capital campaign is a more deliberate, goal-oriented fundraising strategy to support a capital project. In a capital campaign, you might be targeting personal donations, corporate donations, foundation donations, and grants. Just remember that your equity sources will need to be committed and available at the time you close on financing, though some organizations, like Capital Impact, offer bridge financing to bridge these funds as long as they are fully committed. Now, shifting to debt. Depending on the level of equity you anticipate, estimate your financing need. A key consideration when thinking about taking on debt is the level of debt the project can support. For example, when you buy a house, can you afford the monthly payments with your monthly income? Similarly, with a capital project, can your organization afford the monthly payments? Or does the project itself generate sufficient cash flow to cover the loan payments? In assessing your capital needs, there are things to consider that may impact the capital options, both grants and loans available to you, namely program eligibility requirements. You should consider these requirements in the concept and pre-development phases. First, you'll want to consider the mission fit. Grant makers and impact lenders look for projects that align with their mission and demonstrate a high social impact. For example, for greenhouses, the percent Medicaid population served or the percent Medicaid-Medicare dual-eligible population served at your greenhouse is used as an eligibility criteria for some programs. Foundations or other grant or lending sources may have other criteria depending on their mission focus. Second, you'll want to consider your location and site selection. The site you select can have an impact on your eligibility for grant or loan funds. There are a variety of local, county, state, and federal programs that could benefit your project. For example, the U.S. Department of Agriculture programs require that your project site must qualify or be located in a USDA-defined rural community to be eligible for financing options. Similarly, the U.S. Department of Treasury New Market Tax Credit program, to qualify for that program, you must be located in a federally defined distressed census tract to be eligible. There may be other grant or loan funds available from your city, county, state, or federal government as well, such as a specialized redevelopment or development zone. Now that you've developed a capital strategy and determined your capital need, you are ready to explore financing options. Let's consider some of the sources of debt that can be used to finance a greenhouse home. These sources can be divided into 4 big buckets. bonds, government-backed loans, traditional loans, and non-traditional loans. One source of debt is a bond. A bond is a debt investment in which an investor loans money to an entity, corporate or governmental, that borrows the funds for a defined period of time with a fixed interest rate. Bonds are used by companies, municipalities, states, U.S. and foreign governments to finance a variety of projects and activities. Bonds can be public issue or private issue or placement. A public issue bond is issued by a governmental entity, federal, state, or municipality. Generally, these bonds are tax exempt. If you are a governmental entity interested in building greenhouse homes, this could be an option for you. A private issue bond can be issued by a company, just as a company can issue stock. If you are a large organization with a high credit rating, this could be an option for you. A second source of debt is government-backed loans. There are several governmental groups that offer financing opportunities that can benefit greenhouse homes. These groups include the U.S. Department of Housing and Urban Development, or HUD, the U.S. Department of Agriculture, or USDA, the Small Business Administration, SBA, as well as other public entities. These loans may be direct loans from the public entity or indirect loans that are managed through a lender that has been approved by that public entity. So for HUD programs, those are primarily opportunities for nonprofits, but there are some for-profit options. For USDA, those opportunities are for public entities, for-profits, and non-for-profits. There's very little limitation on the type of entity. For the Small Business Administration, those are primarily for for-profits, so there are some nonprofit opportunities. Other federal, state, county, or city entities may offer financing opportunities that could benefit greenhouse homes. For example, if your project is located in a specialized development or redevelopment zone, you may be eligible to apply for funding as a project supporting these broader public initiatives. Both the USDA and HUD programs provide organizations with long-term, low-interest rate financing. That said, there is typically a more rigorous process to secure this type of financing. Often organizations work with financial consultants or lenders that have significant experience with this type of financing to help them navigate the process. Of the government-backed options, Capital Impact is a USDA-approved lender under the Business and Industry Loan Guarantee Program. I will provide more information about this program when I present financing opportunities available at Capital Impact. For more information about loan programs offered by other government agencies or other programs offered by USDA, I recommend that you get in touch with your local or regional representative at these agencies to see what your project might qualify for. A third source of debt is traditional loans. Traditional loans are from a commercial bank, community bank, or credit union. These organizations are federally regulated depository institutions. In other words, they accept personal and or business-related deposits as well as they are also lenders. They provide a number of loan products that range from short to long term that can be used for a variety of personal or business purposes. So personal purposes such as lines of credit, an auto loan, mortgage loan, student loan, and business purposes such as lines of credit, commercial loans, real estate loans, acquisition, construction, renovation, rehab, and facilities loans. The fourth source of debt is non-traditional loans. Non-traditional lenders include CDFIs like Capital Impact, community development entities, or other community loan funds. These organizations can be for-profit or non-for-profit and will vary widely in their size. They are often local or regional, though there are a number of organizations that have a national presence like Capital Impact. They will also vary widely in their development or mission focus, capacity, and loan products. Overall, the type of lending products will be substantially similar to a bank, though in many cases they are more flexible and affordable than a bank. These organizations get their capital from a variety of sources. It can be self-generated from philanthropic sources, from government sources, and also from commercial bank sources. Now we're going to take a slightly deeper dive into financing opportunities available at Capital Impact. In order to be eligible for financing through Capital Impact, there are a few general eligibility requirements. the project must be a greenhouse project and comply with the greenhouse certification standards set forth in the Greenhouse Trademark Agreement. To align with our mission, greenhouse homes must serve a minimum of 40% Medicaid residents or 40% Medicaid, Medicare dual-eligible residents. Finally, the borrower must be an organization, not an individual. Capital Impact provides a variety of loan types ranging from short to long term. This slide provides a snapshot of the general loan types that might benefit your greenhouse project. Capital Impact offers pre-development loans, facilities loans, both construction and term loans, as well as equipment loans. Our facility loans cover a variety of loan purposes including new construction, renovation, expansion, acquisition, takeout or refinancing, as well as gap and bridge financing. Generally, we can lend up to $5 million. However, we are able to partner with other lenders or organizations to finance larger capital projects, and we can help facilitate that process. Now I'd like to highlight two of Capital Impact's loan programs that can be used to finance greenhouse homes. The first is the New Market Tax Credit Program. The New Market Tax Credit Program is an investment vehicle created by the federal government that attracts investment capital to low-income communities by permitting individual and corporate investors to receive a tax credit against their federal income tax return in exchange for making equity investments in projects located in or serving underserved communities. This is a very prescribed program or product that I won't go into depth in this presentation. However, I have highlighted the key terms and some of the benefits provided by this program. Some of the key terms are loan amounts must be greater than $5 million to really make this product viable or worth the cost. The term of the loan is 7 years. The loan is interest only at a fixed interest rate. And at the end of 7 years, the program structure unwinds and the project receives a significant debt forgiveness, and the project must also refinance the remaining hard debt in the project. On one hand, this program is complex and complicated and somewhat costly from a fee perspective. On the other hand, it can offer significant benefits to borrowers. Loans have a favorable blended interest rate. There's potential for a very high loan-to-value, 90% or more. It minimizes debt service with a low rate and long interest-only period. And there's the potential for substantial debt forgiveness, which is about 20 to 25% of the total project cost. Capital Impact is a New Market Tax Credit awardee, and we apply every year to the U.S. Department of Treasury to receive an allocation of available tax credits. We can help eligible borrowers and projects structure these transactions. In thinking about eligibility for the New Market Tax Credit Program, there are requirements for both borrowers and project sites. For the purposes of this presentation, I will highlight the two main ways that a project can be eligible for the New Market Tax Credit Program. The primary way is a project qualifies to receive New Market Tax Credits is through its location. A project must be located in a distressed, but preferably a highly distressed, census tract. The eligible census tracts are determined by the CDFI fund based on a set of criteria, a combination of poverty rate, median family income, and the unemployment rate. There are several mapping sites available to you to help identify whether or not your project is eligible. However, it's a good idea to check with an expert to confirm eligibility. Capital Impact can check or confirm a site for eligibility using a complete project address or a census tract number. A second way to qualify is through targeted populations. In other words, your project can qualify based on employees, owners, or customers that it serves. That said, this process is much more onerous and therefore less appealing to many groups involved in New Market Tax Credits, but it has been done and it is possible. Another Capital Impact loan program that can be used to finance greenhouse homes is the USDA Business and Industry Loan Guarantee Program. The purpose of the B&I Guaranteed Loan Program is to improve, develop, or finance business, industry, and employment and improve the economic and environmental climate in rural communities. This purpose is achieved by bolstering the existing private credit structure through the guarantee of quality loans which will provide lasting community benefits. I have highlighted the key terms and some of the benefits provided by this program. Loan amounts up to $10 million with 70 to 80% loan guarantees from USDA, terms up to 20 years, fixed interest rates that will vary based on your project. The benefits of this program to a borrower are generally higher loan amounts, lower interest rates, and longer repayment terms. To qualify for the USDA B&I program, you must be an eligible business located in an eligible area. An eligible business is any legal entity including nonprofits, for-profits, and public entities. An eligible area are rural areas, including all areas other than cities of more than 50,000 people and their immediately adjacent or urbanizing areas. You can use the USDA website to identify whether or not your project is located in an eligible area. Capital Impact can also check or confirm a site for eligibility. And finally, applying for financing. So getting back to the facility development process, we recall the financing process begins at the end of the concept phase and the beginning of the pre-development phase. Once you have a clear idea of your project, capital strategy, and approximate capital needs, you can begin applying for financing. Lenders will require a package of information in order to understand and evaluate your request. This financing package and process will differ from lender to lender. Typically, there are two stages in this process: an informal approval process during the pre-development phase and a formal approval process during the development phase. In the higher level approval process, you should expect some kind of informal financing commitment, a proposal, letter of interest, or a term sheet. This stage is intended to lay out the basic terms and conditions that the lender intends to lend you the funds you requested. These agreements are not typically legally binding. Depending on the lender, there may or may not be a fee associated with this step, such as an underwriting fee or a deposit. In the more in-depth approval process, you should secure a firm financing commitment or a commitment letter. This stage is intended to detail the terms and conditions that the lender will lend you the funds you requested. Once executed or signed, these agreements are legally binding. A commitment letter represents a firm commitment from the lender to provide financing for your project. Typically, commitment letters require a fee, usually a portion of the origination fee, and potentially an expense deposit if one has not already been collected. Again, the financing package will differ from lender to lender, and depending on the level of financing commitment, informal versus formal, the level of detail will vary. Typically, a financing package will consist of background and project information. So for background information, if you are an existing organization, a lender will be looking for background information on your organization, scope of operations, experience, and financial performance. This would include an organizational summary, including the scope of your current operations, management resumes or bios, 3 years of audited financial statements and year-to-date interim financial statements. Lenders use this information to assess the overall strength of an organization and its ability to manage the proposed project operationally and financially. On the project side, in terms of project information, a financing package would include a project description, project team bios, sources and uses or project budget, any due diligence reports that might have been completed on the property, market or feasibility study, and 5-year cash flow projections or a 5-year pro forma. Lenders use this information to understand the project and your financing request in order to structure a financing solution that meets your needs. But what if I'm a startup? On its face, this kind of transaction has a higher level of risk. Most lenders, including us, will require that you demonstrate an operating history. We typically require a 2 to 3 year operating history. Defining a startup can be tricky, however. Generally, a startup is an entity that has no operating history. However, you may be an existing operator in the senior living area, for example, that chooses to create a new entity for the purpose of creating or managing a greenhouse home. But your existing entity will actually operate the greenhouse. So while the project itself is a startup, the operating entity is not. In considering startups, lenders will be more open to a situation or structure like this. If you are a startup entity, the project information, particularly the project team you put together, will be that much more important. A lender will want to understand how the project is coming together and obtain information and qualifications on all the parties involved. For a greenhouse project, having a strong, experienced operator and a strong financial backer would be important. You can also expect additional collateral to be required, such as a corporate or personal guarantee. So we'd now like to open it up for questions.